247 years ago, our nation was born. Our founding fathers had a simple but radical idea: to build a nation where every individual would have the freedom and opportunity to become their personal and professional best. Throughout our nation's history, there have been different seasons. Seasons of peace and prosperity, and seasons of war and hardship. Today, we visit our nation's capital, Washington, D.C., during a season of uncertainty. We come to Washington the day after the Federal Reserve made a decision to increase interest rates for the 8th consecutive time in the last year. The Fed's decision has impacted our entire economy, but most significantly, it has impacted the industry that many of us work in: housing and housing finance. So today, we're headed to Fannie Mae, the Federal National Mortgage Association, the largest housing finance company in the world, to meet with its chief economist, Duncan, to offer you the latest and best information to share with your customers. Because service professionals who know more, they can offer more. And when you offer more, you get one step closer to your destination. Destination Best. Doug, welcome to Personal and Professional Best.
Thanks.
Fascinating morning, right?
Yeah,
lots of news.
That's why I had a little pause. I'm still a little bit struck.
After the unemployment number, get a little oxygen this morning?
Yeah, exactly.
So before we get there, because this was a big week in news, especially today, I want to talk about reflecting back a little bit, because in context, all the news that we're getting today is kind of the consequences of some things that have happened over the last couple of years. And I do want to put things in context. So January 2020, about 3 years ago, the nation's at 3.5%, like a generational low in unemployment. Today we're down to 3.4. We are at 3.5% 30-year fixed rate mortgages. The economy is growing at less than 3%. So it felt kind of normal. Mm-hmm. And then we had this thing called COVID that actually arrived. And since then, you and I have talked about this in the past, there's kind of two words: unprecedented and extreme, that seem to describe everything. So talking a little bit about that. We closed the economy, lost 20 million jobs, closed the economy for the first time, lost 20 million jobs in 30 days, went from 3.5% unemployment to 14. We did stimulus, and then stimulus, and more stimulus, which isn't all that different, but the amount was different. Interest rates went from 3.5 on mortgages to 2.5, and the Fed was negative on interest rates for all intents and purposes. Housing sales, of course, with 20 million job losses, they went up a lot.
Naturally.
Right, and so did home prices. So how's it been to be a forecaster the last 3 years?
Just kind of sit on a couch and muse, and then get panicked because you have no idea where things are going to come from. The COVID was a health variable. It wasn't an economic variable. It was a health variable with economic implications. Like, people don't want to be next to other people, particularly after we learned a little bit, like a month or two in, that if you're older and you have some other medical issue, this could be really bad for you. And it was for a lot of older folks. It took us some time to learn exactly how that health variable was going to impact how people behaved. Then businesses would assess how people behaved, and they would decide what actions they should take. And of course, then government would weigh in with what they thought with regard to public safety. That took time. In the meantime, the economists are arguing which letter of the alphabet the economy is going to look like: V or a W or a K. The Nike swoosh, my favorite, was the square root symbol. Yeah, I mean, just lots of things that don't fit neatly into economic models.
And it feels like all of that, kind of, now we're getting back to, are we getting back to normal now, finally? I mean, people are showing up. There's people here at the office now with Fannie Mae. I actually talk to people. I know yesterday you said it's one of the first times that you've met some of your staff, and you thought they were either smaller or bigger than they
Right.
are.
They're like, oh, you're tall. You look up.
But there does feel like, restaurants, everything's kind of full again, and employment, people are starting to come back a little. Are we getting back to normal? Beside the economy, which we'll get to here in a few minutes.
Yeah, well, we were in New York last week talking to a whole bunch of different media outlets, which the employment report this morning obviate all of that. But it was probably 75% back. We talked to a bunch of people and asked them, what do you think? And lots of people are coming back to the office. Not every day, but it was more traffic than in D.C. Here, government is a more dominant employer, so then the government has still allowed a lot of work at home.
Yep.
So it's less so in D.C. Normal. What is normal? Because we significantly disrupted the older population in a couple of ways. One is, from a health perspective, a lot of additional deaths that were not anticipated pre-COVID. And a bunch of people left the workforce that are probably never coming back to the workforce, maybe left earlier than we thought they would, either because of fears on the health side or because they got some money through the stimulus that allowed them to make that transition. So I'm not sure that using the word normal is going to be useful yet for another couple of years.
Hopefully someday you and I will talk and you'll go, hey, normal showed back up. Right? So the Federal Reserve has been in the news a lot. And in my 37-year history in business, when the Fed is in the news a lot, it's usually not good. It's usually because something's happened and they're lowering interest rates to somehow or another try to get things back on track. Or in this particular case, it's the opposite that's going on. But let's start out with, what is their responsibility and their mandate, the Federal Reserve?
They have what's called a dual mandate. In other words, two things that they have to focus on equally. One is controlling inflation, and the second is maximizing employment. The controlling inflation is probably closer to their wheelhouse than maximizing employment, but that's their mandate, so they attempt to do it. My personal view is that you can maximize employment by lowering inflation as low as possible to zero even, which clarifies price signals in the market so that parties making arm's length transactions know what the values are. So they conduct those their efforts to meet the responsibilities through managing short-term interest rates. That's their traditional tool. They have, in this instance, also used their portfolio and expanded their holdings of treasuries. We didn't even know that
they had one, right?
Well, they've always had one, but it's been a very constant relationship with the overall economy. Grows a bit, essentially to offset the amount of cash that has to be held in the economy. This time, however, they did quantitative easing, which is expanding it, supposedly increasing liquidity, maybe driving people out the risk curve to take more risk to accelerate economic activity. Now they're quantitative tightening because inflation jumped and they got behind the curve on inflation. So now they're raising interest rates. They just did another 25 basis points on the Fed funds target a couple days ago. And they are running off that portfolio to get it back. They haven't really said how far they're going to run it off, except they don't want to hold any mortgage-backed securities in the long run.
So the Fed's in the forecasting business.
They are.
Yeah, they're in the forecast. And you're an expert in forecasting, right?
Well, my mother says the word expert is two words. An X is a has-been, and a spurt is a drip under pressure. So I know a little bit about forecasting. Let's leave it there.
Let's leave it there. So they're in the forecasting business. The last, since COVID started, all the things that happened subsequent that, and the Fed was the first attempting to buffer the economy, right? 20 million job losses.
Right.
So
Absolutely.
They faced off with the unprecedented extremes and focusing on their mandate, right? Full employment and inflation. Did they just miss the inflation thing?
I think most people miss the inflation thing. I don't. There's a lot of people talking about it after the fact, but the number of voices calling, "Watch out! There's huge inflation coming," pretty minimal, including we were not in the camp. We had a higher inflation estimate than others did, but we weren't shouting, this is going to be 10% inflation or anything like that, which it didn't quite get there. But that, a big change. So they were behind on that, but they responded forcefully. There aren't many episodes in history where the Fed has made 3 consecutive 75 basis point increases in the Fed funds target. So once they recognized it, they acted aggressively.
Yeah. So if they got it wrong, is it because there's 40 years prior of relatively low inflation? And so you just get complacent assuming that the circumstances of COVID and the consequences of what they had to do with the economy wasn't going to create an environment where it was going to show back up again? Is that part of it?
Well, we did go through a 40-year period of declining nominal interest rates with periodic bumps of inflation up, nothing like we've recently had. And the tools seem to work pretty well over that time period. But the COVID was something completely different. And so it did call for rethinking things. And, they have a lot of smart people at the Fed. So they just didn't get there in time, partly because it was uncertain about what's normal. To go back to the beginning of our conversation.
It's interesting because we told everybody go home for safety purposes. So all of the workers around the world pretty much, and we shut down factories, everything else. And then we gave people money to buffer. It was maybe innocent enough that we did that, but I'll never forget, in the midst of COVID, everybody still wear a mask. My wife goes to shop at Phipps and she walks by a luxury purse store. And she said that night to me that there were like 300 people in line to get in the store. And I was processing to myself that normally there's not 300 people in line, right? So it feels like in some ways that we just created because of the circumstances. We created this imbalance, supply and demand, and now we're just in the consequences. So the Fed is the firefighter for inflation, right? And they've got all the trucks now out, and we're trying to douse this thing down. Right. They got it wrong. Are you comfortable they're getting it right now?
Well, headline inflation is coming down, so they can make a claim there. The housing stuff is pretty well known, and I think they're aligned there. The question is framed by Chair Powell in his press release about non-housing services inflation, which has not come down. And he was getting some heat in the press conference on that point. I don't know others that have better answers. I tend to agree with him when he says we need to take the Fed funds target rate to what we think is the terminal rate, which I interpret to be the rate that is above the headline of inflation at that time. Headline inflation is now not yet below 5%, and their terminal rate, if you look at their dot plot, is 5 to 5.25 for the target. I think they'll get there, and if the headline numbers don't come down under that, they could go back further because they've been very clear that they are more than any time in the past data dependent. So from meeting to meeting, particularly from quarter to quarter when they do their dot plot and the summary of economic projections, they are looking at the current data like everyone else.
Yeah, the intensity's picking up for all of this now, right?
Absolutely.
Because every number that comes out is a story about what's next, in terms of their action.
Well, you'll see in the market today with this employment number, I'd be surprised if the 10-year Treasury is not higher at the end of the day than it is, and the market is down because they're going to read into this. Well, what Powell just said in his press conference a day or two ago about the non-housing services sector employment numbers, 3.4% unemployment, added 517,000 jobs. Most of that growth was in the services space. The average work week lengthened. The amount of overtime increased, and pay increased 4.4% year over year. So all those things give the Fed the justification.
I think he needs a new tool, because apparently the one that he's been using for the last year, specific on the employment number today, either that or we need someone to count the numbers again, right? Because the numbers today were just absolutely, which we'll get to in a minute. Let's shift now to housing, right? Our audience is our folks, of course, who work in the housing finance business. And indeed, maybe some of them are getting those jobs because housing finance is not doing so well these days, that are in the services sector. But so we have the real estate community today, we have the mortgage banking community today, and then we have some buyers and sellers that are going to be in the audience. No doubt they're going to be listening to you, because this moment that we're in right now, for myself, our team, for the real estate community, we're service professionals. And as I tell people, when you know more as a service professional, you can offer more value to your customers. That's just the nature of the business, and those that are best at information and knowing more can do more. So, but this environment, for people who are thinking about selling and thinking about buying, you know, the environment creates fear, because there's so much volatility, right? Yeah. You just don't know exactly and specifically you know, how to make decisions, the best decisions. But let's start out with what drives the housing market. What are the fundamentals, so that if you're a real estate agent, mortgage banker, buyer, you're out there, this is what are the key things that drive housing. What are they?
Well, first of all, it's people.
People.
It's how many there are, what kind of households they form, and what's the content of, and the age, for example, of those households. So people live with their parents until they maybe are teenagers, then they might live in the basement, then they go to college and they live in a dorm, and then they get out and maybe they have a couple of roomies for a little while, then they find a roomie they want permanently, and they get married and have babies, and then they want to buy a house.
They want to buy a house.
And the next thing that is going to be asked of them is, do you have an income? And is that income stable? And do you pay your bills on time? And so income is the next thing. And you'll find that the population groups migrate to where there are jobs, because it's the jobs that provide the income. So it's really employment when you get to it.
Yep.
And that's why those numbers we're going to talk about today were so important. Then after that, it's affordability. Because you may you've got the household that wants to own a home, you've got an income, it's stable, you've managed credit well. All of that line up with the houses that are available and the prices of those houses and the cost of credit if you're going to have to use credit. And so that's the challenge today, is there are people who want to buy a house. We survey them monthly. And today they think it's a bad time to buy a house because house prices have been so high. They do think they're coming down a bit. Interesting, our National Housing Survey, one of the things we've learned since June of 2010 when we started it, is people are really tuned in today to small changes in things around them. The survey picks up much more sensitivity to the environment today than 10 years ago. It's
just information flow.
Yeah.
Right? People get access to information. Yeah. It's much better these days.
So they're really tuned in to when there's a 3% decline in house price, you know, they're going to jump if also interest rates came down, which they have. They've come down 100 basis points from their peak or thereabouts.
So if we're talking to our audience, and we live in the South, right, and demographics, so demographics matter, and there's movement in the country where demographics are actually moving these days. So the South, check the box. Yeah, they're moving to jobs, right? And then, so there's demographics, there's employment, the jobs are there, so that's good. And then the affordability issue, the last couple of years, we had record inflation in housing, right? Demand, you know, and supply got so out of whack. Some of the stories are just absolutely fascinating. And then the other huge ultimate dropped last summer, which is the cost of money. So the demand for housing drove prices up, and there were still a lot of people in the market. But then we had the second part of the affordability shoe drop, and that really kind of quieted the market down, which we'll get to in a second.
Yeah, June was kind of the switch point.
So if you really want to know where housing's going, you follow those three issues, and then you track your forecast.
Well, Well, maybe up till today.
Yeah, but you don't date your forecaster. Tell us the story again about how you should actually, as an economist, how you actually should do it. You kind of forecast a number, but not a date. What is it?
Yeah, well, that's the 3 rules of forecasting. Yeah, if you give a number, don't give a date. If you give a date, don't give a number. And then if you get it right, don't look surprised. Right?
So if they track your forecast, they just won't see dates, right?
Yeah, right.
Unless you're right, in which case you'll
Unfortunately.
show up and take credit for it.
Yeah, we're kind of out there. That was one of the things I thought about when I was first offered a job as a chief economist, which included a public forecast. Was I had to think about how do I feel about being publicly wrong? Because people expect a point estimate of everything, and the best you can do with these models is the direction and the range, really. So.
Well, the last couple of years has been probably the hardest on record to forecast, just because of all the different circumstances.
It really called into it judgment, and it called into it the sociology side of economics.
How people are going to behave, right?
Yeah,
Yeah.
yeah. So, and that is where I've found my interest in economics is on the sociology side. So that helped us, and we won an award for forecast accuracy on a 4-year look back, which included that pandemic time period. And so the focus on people and their behaviors and applying that to judgment to adjust the model really was valuable during that time period.
So let's talk about last year. So 2022, for me personally, great year. Me and Lisa, family, everything was great. Professionally, the first 6 months was fabulous.
2 different years,
yeah,
right?
It was the tale of 2 years.
Absolutely.
So the lights were on in housing. The first 6 months, interest rates were, under 4, a little bit better than 4. Prices had gone up the previous 2 years, but there were still a lot of people in line to buy a home. And then in the early summer, we saw rates go up faster than they've ever gone up in the shortest period of time. Went from 4 to 7+%. And I don't even think our loan officers knew how to say 7.
Yeah.
But they started having to say 7+. It was difficult. And it was like someone shut the lights off in the second half of last year.
I got in trouble for saying that the housing market stopped in June, and people said, you can't say that. And I said, well, where is it? Where is it?
Well, I can verify you were right, okay? Because we were in the business, and it was like in a minute when rates went up. And I think, some of it is just the shock of I got qualified. I thought I was going to pay a 4% rate, and now all of a sudden it's 7. But I think the bigger issue was just on top of the 2 years of appreciation on housing prices, we just ran out of affordability.
Right.
So your third point about what drives housing, we just ran right into the wall of affordability. So we'll get to your forecast for 23. Mm-hmm. And I do want you to tell the truth. It's personal, professional business. We'll have to do. I wish you didn't have to.
Yeah.
So we could give hope and but anyway, so November, the numbers. It feels like to me, because I'm looking at your 2023 forecast, and I'll remind our audience that he's been celebrated a number of times, you and your friends at Fannie here, your team, for your accuracy. But the November actual number of housing sales, it feels like that was the low point, even though the year forecast you have for 23 is below 22, because the second half of 22 was so, lower. So much lower. It feels like November might have been the bottom because it was running about 4 million annually.
That's about what our total expectation is for 23. It's
23.
about 4 million.
Yeah.
And that includes all the seasonal effects and all of that. We until today's employment report, we had thought, well, maybe we've had a mild recession in our forecast since last April. Mild, primarily because we felt housing was going to be an engine to bring it out of that recession, because we haven't solved the supply problem. There still are very low levels of supply, and there's pent-up demand. You saw that when rates were at 4%. There's a lot of people.
We still had lines.
Yeah, absolutely. So what today's numbers suggest is that rates are going to go back up again. And so we got a little breather. And in our monthly survey, you saw the last couple of months, we'll come out with another one, I think on Tuesday, we'll get an update on that. But the previous 2 months saw a little bit of an uptick from very low levels of it's a bad time to buy, or it's a good time to buy a house. Most people were saying it's a very bad time to buy a house. That's the affordability story. Others were saying it's a bad time to sell a house. Two things going on there. One is because of the affordability issue, they didn't think to get the customers to actually pay the price they wanted. And they were seeing some declines in prices in their markets, and they didn't want to sell into a declining market. We'll come out of that. Now, whether the employment data that we showed today leads the Fed to extend or strengthen their tightening remains to be seen, probably keyed off of what they see in the inflation numbers, the headline and core, and what Chair Powell is very clear to define as non-housing services employment, which is really the labor market code for.
So if we get good inflation numbers in the next couple of weeks, we've had 4 months in a row where we've had declines, right? So the trends have been good.
The core has not come down as much.
Yeah, today's employment number, by the way, comes in at 500+ thousand jobs.
517,000.
And the forecast was under 200.
Yeah.
Which is, it's almost hard to believe. And I saw the number this morning. I thought, I'm sure you did too. Someone check those numbers.
Yeah, well, that was the first thing. Could you look at the seasonals? Are they saying there's a problem in the seasonals?
There's some explanation.
Right?
But, actually, so assume that the inflation numbers over the next couple weeks continue the trend we've seen, right? That they're continuing to moderate. It feels like if employment comes back down to maybe a more normal number next month, it feels like this Goldilocks scenario might show up, right? Where the economy actually, because jobs are healthy, environment is good, and we're starting to see inflation come back to us. Is that possible?
It's possible. There are some very strong indicators that in the past have been tied to recession. Decline in manufacturing, and manufacturing, like housing, has been in a recessionary mode. The yield curve, it was already steeply inverted. It's even more steeply inverted. That has a great prediction
for recession.
Leading economic indicators has been down for several months in a row. It has a great record of predicting recession. And then you get this employment report that's just completely out of the box related to those.
So it feels like we started today's conversation exchange unprecedented, extreme, non-normal. And it's almost like all the things that line up that tell us that a recession is in fact coming. Who knows what's next, right? I mean, it just doesn't seem like everything is fitting in. Certainly today's number feels that way. Does the news today, or do you just need more data points? Have you rethink at all your forecast for housing this year?
Yeah, we'll have to. Every month we review our forecast. If you've looked at it, we forecast quarterly results, but lots of data come out on a monthly basis, so we update those results every month. So we review everything every month to look at the relationships which we think matter. And we just went through ones for housing.
Yep.
This strength in employment and the continued strength in income suggests that perhaps the economy will not only just maybe have a soft landing, but it could even be better than just a soft landing. And the income catch up at the household level on the affordability side might be faster than what we think. We'll have to, I'm not ready to claim that yet, but it is something we're going to have to look at. Because the thing that shut the market down in June was exactly what you said, which was this dramatic sudden rise in rates. And it's the mismatch with income growth that makes that a problem. Incomes don't adjust suddenly.
Right.
They adjust over time, over the course of a year. So if there is this strong growth that is sustained and employment that's sustained, then the bottom of housing may not be where we thought it was.
Yeah. So what's the upside, downside risk for housing? Kind of if you were just to, spitball, hey, look, this happens, housing will be better than expected. This happens, maybe not so much.
Yeah, the downside is probably more direct, and that is if the Fed concludes from this that they're going to have to be tougher to sustain a lower level of inflation, that means rates will go up, and that will be harder on housing. Also, it means that they will push harder to ease. When they say softening in unemployment, it means people lose jobs.
Yep.
It's a code word for that. Now, some of it is new entrants simply don't find jobs, so they're also unemployed. They didn't lose a job, they just weren't able to find one when they became a participant. So that is in our forecast, we expect both of those things to happen. It certainly hasn't happened yet. So that would be the downside, much tighter monetary policy. The upside is if in fact the inflation indicators continue on a downward path, and the Fed says, you know what, we're going to let this run for a while, then the upside is incomes, which they grew at 4.4% year over year. That will catch them up to where interest rates are, and mortgage rates have come down. Part of the mortgage rates coming down, and I know you know this, some of your borrowers your partners may or may not realize, part of the issue in the mortgage space is when you originate a mortgage, if you're going to sell it into the secondary market, there has to be an investor that's willing to buy it at a coupon. Not at 7%, because nobody believed a 7% mortgage was going to last.
Right. They just thought you'd make the mortgage,
Right.
it'd pay off in 6 months or a year.
Yeah. So borrowers had to bring money to the table to get an execution.
Yeah.
So with the rates having come down, some of that pressure has eased. And there are securitizations in the 6 range or 5.5 range, something like that. So that's actually helped. A lot of, at the margin, that has allowed some people back into the purchase side of the equation, which wasn't available.
I think one of the things you said that's really important for our viewers about buyers today, about people able to buy, affordability-wise, is if you go back to the summer of last year, rates go up immediately. Their income didn't. Right. But now we're seeing incomes climb in the process, right? Today's numbers in the mid-4s. So you're closing the distance. Rates came down a little bit. And you're closing the distance on the interest rate kind of spread that took place that made affordability a little bit more difficult. And indeed, anecdotally, as I told you in the last couple of weeks, it seems like since the beginning of the year, with rates coming down from the 7 handles to the 6 handles, demand is that unmet demand. It's starting to show back up.
Yeah.
The market's not great by any stretch, but it's clearly better than it was in the fourth quarter.
Well, the markets are pretty smart. You saw stocks of home builders rising pretty substantially. So the market recognizes the supply problem has not been solved.
No.
And it's really on the backs of the builders, because now it's not only that the boomers are doing what they said they were going to do, which is age in place, but the Gen Xers, who nobody respects or talks about, locked in those 2.5% to 4% mortgage, and they're going nowhere either. So the supply problem, I'm sorry, I had to bring the Gen Xers in. The supply problem still exists, and the millennials still want to buy houses. They're not at the peak first-time home buying age yet.
So having been in this business for quite some time now, you as well, obviously, the short-term event that took place last year, cycles do take place, right? And we've just gotten a little bit of out of whack right now. But if you go back to what you talked about, demographics, certainly where we live in the South, but very favorable. Employment right now as favorable as it's been in 50 plus years in terms of the environment for jobs. Yeah, the last issue is just affordability. And the good news is sellers have a lot of equity built up in the last couple of years. So those that do want to sell, they can lean in some and still earn a higher rate than they ever expected.
Yeah, that's right.
Starting a couple of years ago. So there'll be some business out there to do.
For those who've been in the business for a long time, no, it's cyclical.
Yeah.
It's 2007 to 9 was unusual. If you go back to all the cycles prior to that and the current cycle, the same thing happens every time. The Fed tightens because of a rise in expected inflation. That when they tighten, construction, residential fixed investment starts to fall. The third thing is that new home sales start to decline, and then existing home sales start to decline. Same cycle every time. We're seeing that this time. No surprise.
No surprise at all. And good luck making heads or tails out of that number today. I'll be praying for you the next couple of days.
Yeah, it'll be interesting. And I appreciate the invitation to participate. I know you run a great company, you run it well. So
thanks so much.
Pleasure.
Thanks. We hold these truths to be self-evident, that all men are created equal, that they are endowed by their Creator with certain unalienable rights, that among these are life, liberty, and the pursuit of happiness. These famous words, they were penned by Thomas Jefferson, who spoke our nation into being. Over the last 246 years, the great challenge for the United States of America has been to live up to the aspiration of its foundational creed, that all men and women are created equal. We've come a long way as a nation, but we have work to do individually and collectively to become our best. Behind me today is the Martin Luther King Memorial. His gaze is staring directly at the Jefferson Memorial, and MLK had something to say in response to Thomas Jefferson because he had a dream.
Because I have a dream that my 4 little children will one day live in a nation where they will not be judged by the color of their skin, but by the content of their character. I have a dream today.
Every time I come to Washington, D.C., I'm inspired by the history, the architecture, the grandeur, but most of all, by the people. Ordinary people, people like you and me, who come to this city to learn about its past, but return home inspired to help make this nation's future the best that it can be. A future that embodies Jefferson's vision and Martin Luther King's dream. There's another quote by Martin Luther King Jr. that hangs on the wall of Supreme Lending. You know what it says? Everybody can be great because everybody can serve. As a nation, the United States has always been at its best when we come together to serve one another. From our brave soldiers who defend our freedom, to our educators who shape the minds of our future leaders, to our caregivers who tend to the sick and vulnerable, and to you and me when we serve our customers with a commitment to excellence. Our nation's greatest president, Abraham Lincoln, quoted scripture when he said, "A house or a nation divided against itself cannot stand." Service is not only the path for you and I to become our best, it's also the way that we heal the wounds of our nation, serving others before self. It is through serving that we find meaning and purpose, and it's through service that we build strong and vibrant communities. Thank you for joining us today. I hope and pray that you, like me, have been inspired by this trip to our nation's capital. I know that you've been educated, hearing the fresh and encouraging insights from our good friend, Doug Duncan. Now that you know more, you can offer your customers more and serve them better. I also hope and pray that you leave this program reminded that service is the key to America becoming great and the key to you becoming your personal and professional best. Best is waiting. Meet you there.